In recent months, Palantir stock has been on a meteoric rise. After recently being added to the S&P 500 index, they have been outperforming many of its peers, being the third best performing stock this year. But what's driving this explosive growth? And is it too late to jump on board? In today's video, we'll dive deep into the world of Palantir Technology, examining its recent performance, the underlying fundamentals that have fueled its success, and whether its valuation is justified. So, buckle up and get ready to uncover the secrets behind Palantir's stock market frenzy. Let's explore the reasons why this tech giant is making waves and whether it's poised for continued growth. First, what does Palantir Technologies do? Palantir builds software that empowers organizations to effectively integrate their data, decisions, and operations at scale. Founded in 2003, they started building software for the intelligence community in the United States to assist in counterterrorism investigations and operations. They later began working with commercial enterprises. They have built four principal software platforms: Palantir Gotham, Palantir Foundry, Palantir Apollo, and Palantir Artificial Intelligence Platform, AIP. Palantir works with many of the world's leading government and commercial institutions. In the end of 2023, they had 497 customers. Their software is currently used across approximately 80 industries around the world. It is applied to a variety of use cases by users across various business functions and levels of organization, including utility, automotive manufacturing workers, oil and gas technicians and operators, and pharmaceutical researchers in the United States. They also work with supply chain managers in South Korea, assembly workers in France, public health administrators in the United Kingdom and United States, and special forces personnel and military officials in the United States and abroad. Of the 2.2 billion in revenue that they had generated in 2023, 55% came from customers in government segment and 45% came from the customers in the commercial segment. Palantir stock is doing very well this year, up 162%. In terms of performance in the S&P 500, it's only trailing behind Vistra and Nvidia stock. Since their IPO, the stock is up 373%. And in the beginning of 2023, the stock was trading at a low of $6.4 per share, which has been an incredible run until now. The stock is up 577% since the beginning of 2023, which is amazing for a stock like Palantir. But is Palantir stock overvalued right now? First, let's look into the fundamentals of this company. We already know what Palantir Technology do. They have an incredible product. They build software that is great. They basically had no competition because they are the best in this software business. Their platforms are incredible, and their client or their customer base is increasing. Most of the revenue are contract based, so it's really safe in the future. It's subscribe based, like, or even better because it's government most of the revenues. So it is incredible, and I understand why there are a lot of frenzy and why investors love this company. And as a business, this business model is incredible. But let's look at the fundamentals. Right now it's a $97 billion company, but it's trading at a PE of 256, a forward PE of almost 100. I've never seen so high PEs and forward PE ratios in a company. But their margins and growth is awesome. They have been growing around 30% per year, which is huge. Their gross margins is 81%. It's really rare to see companies with so high gross margins. Net margins around 16%, but their free cash flow margins are even higher. Look into their balance sheet. This is a pretty good balance sheet. They have $4 billion in cash and short-term investments, and they basically have no long-term debt. The returns on equity on invested capital this year was around 10%, which is the minimum I like to see. But these returns have been increasing, and since they are turning profitable right now, and with the scalability that this business has, I do really believe their returns on invested capital will be much higher in the next few years. Uh, Looking at our manager checklists, it's almost all check marks except for one. They have been growing a lot, 30%. Such high gross margin and net margin, great margins, I would say. Low debt, they basically have no debt, and they have plenty of cash in hands. Their returns on equity and on invested capital are not awesome because of the phase this company is, but it's at the bare minimum around 10%. I would say it's a check, and I really believe in the future will be much higher. They have a moat and a competitive advantage. Since we have discovered this business model, they basically have no competition because they are the best in their platforms, and there are not much companies that can compete with Palantir. So I would say they have a wide moat. They have been free cash flow positive in the last years, but they are not returning capital to the shareholders, which is something I would prefer to see in a company. They don't pay a dividend, which is correct because since they are in the that is because they are in the early stage. I would say they are in growth mode already. They are investing all of their profits in the business, trying to build a better product, trying to increase their scale, and trying to uh, have a better product for their customers, and trying to get more customers into their business. That's why they are growing so fast as well, and that's understandable to not be sharing their profits with the shareholders, because for shareholders it's much better to see the company invest in their business. But they have been diluting a lot their shareholders. The shares outstanding have been, since 2019, their shares outstanding, it's a 5x. So you are being diluted a lot. It's something I don't like to see. I'm okay with them not being doing buybacks or not doing a dividend. That's all right. But diluting the shareholders in this way, it's very bad. That's a turn off for me personally. Uh, but looking at the graphs, net income and revenues growing, it's trending high, which is really good. Gross margins increasing right now above 80%, which is great. Return on investment growing as well. Net income or free cash flow per share growing as well at a really high pace. But shares outstanding, I don't like it. Even though right now they are not diluting a lot because they have plenty of money and cash in hand, they don't need to dilute so well, but they issue a lot of stock-based compensation. For example, the stock-based compensation right now, it's around $500 million. It was higher 2 years ago, but bear in mind, free cash flow in 2022 was around $700. They make $700 million in free cash flow positive, but they issue stock-based compensation to the management and employees of around $5 million. So from these $700 million of free cash flow, only $200 million have been creating value for the shareholder, which is really bad. So good news is that the stock-based compensation, it's slowing, but it's still bad. It's two things I don't like to see in this company. So fundamental wise, it's a really great business model, but some problems with the share dilutions, which I don't like. So let's find out if Palantir stocks is undervalued, overvalued, or around fair value. For that, we'll do our discounted cash flow for the next 10 years. Since Palantir, it's a United States business, I would say there are a pretty low risk, it's not a safe investment because they are in the early phase and they always can find the disruption. But I would say this is a pretty low risk stocks because they have a plenty of competitive advantage, and we look to their margins and their growth. I would say that will continue for the next few years. So with that, I would assume a discount rate of 11.5% for my base case. So what should we assume for the next 10 years? In terms of margins, last year they have free cash flow margin around 31%, and since they have gross margins above 80%, I really believe they can have free cash flow margins above 30%. If they had 35% or 40%, I will not be surprised. Look into Nvidia, for example, who sells electronic components or GPUs or these new servers for AI and have higher margins than that. So Palantir, who builds software, can even have greater margins. So I will be conservative. I will assume 32% margin, but it could be 35, and I will not be surprised. Growth. In terms of growth, they are expecting to grow 24% in 2024 and 20% in 2025. So for the next 5 years, I will assume a growth rate of around 16% and 12% for the last 5 years of our discounted cash flow, which I would assume it's not. I really believe Palantir can do this growth, which will be really great. Their revenues will be 5x, I would say, in 10 years, which is really great. For a P, I really believe Palantir deserves a premium because of their business model, even though they are diluting and doing that shit, which I don't like, but I really believe they deserve a premium. So if they grow at this pace with this margin, they deserve around the 22 PE. If you assume 25, I would be okay with that, or the 20. It's always an assumption, but I would say 22 is pretty fair. So with these assumptions, and I will do always my bull and bear case, we came with an intrinsic value of around $9. Right now it's trading at the 43.5p, which is a lot overvalued for me. Of course, this is a great business model. I understand why investors love this company. I do love too, but at this valuation, this doesn't make sense. I'm not willing to invest in a company because imagine if in the next month or in the next year there are some good news or they lose some clients, the stock will tank for sure. And one of the best qualities on invest is patience. We will have other opportunities to get this stock cheaper. Look at 2023, the stock was trading at the $6. It looked overvalued at that time, but it was close to fair value. Of course, a company like Palantir, it's gonna be really difficult to find that at an undervalued price, but we can buy that at a much cheaper valuation. Right now, look at these P ratios of 256, a forward P of 103, and bear in mind they are already having great margins or great free cash flow margins, and they are diluting the shareholders. So even though this is a great company, a great business model, as an investment, it will be a pass for me. It's trading at a really high valuation, and I don't really believe that's gonna turn out to be a really great investment in the future, because investors are already pricing that frenzy in the stock price. So that's my opinion in Palantir, a great business model and company, but as an investment, not the best. So I hope you liked this video, and please, if you liked it, please like and subscribe. See you next time.